Money at Work, continuing financial education series brought to you by Millionaire Mindset Life. Today's video centers all around the debt trap and the shocking reality of bank stranglehold on most people's net income. In the pursuit of the American dream and in the pursuit of financial stability, millions of people turn to the banks for loans to purchase homes, purchase cars, finance education, and on and on. However, what many fail to realize is that this seemingly common debt they take on can become a vicious cycle, funneling a significant portion of their hard-earned net income directly into the hands of the bank. So we're going to explore the shocking reality of how much of people's net income is consumed by banks in the various forms of interest they have and they pay on debt, including mortgages, credit cards, lines of credit, student loans, and car loans. First of all is mortgage mayhem. The dream of home ownership is one that many strive for, but the truth is that a substantial chunk of one's net income is siphoned off by mortgage payments. With high interest, extended loan terms, and escrow, it's not uncommon for individuals to pay 30-40+% of their monthly income just to keep a roof over their head. This staggering amount leaves little room for things like saving, investing, or even enjoying life's simple pleasures. So here's a breakdown of mortgage issues that you need to be aware of. First of all, interest-heavy mortgage payments. When individuals take out a mortgage, especially with the longer loan terms, they often end up paying a significant amount in interest over the life of the loan. In the initial years of a typical 30-year mortgage, a large portion of each of those monthly payments that's made goes to interest rather than actually reducing the principal balance. This means that homeowners are essentially paying to borrow money without ever making much progress in building equity. Second thing is the amortization schedule. To understand the impact of interest on mortgage payments, one must examine the actual amortization schedule to see what's going on. An amortization schedule shows us how each mortgage payment is allocated between the interest and the principal. In the early years, a substantial percentage of the payment goes towards interest, with only a very small portion applied to the principal. As that loan matures, the proportion of payment dedicated to the principal gradually increases over time. Let's look at a real-world example of this. Let's consider a hypothetical scenario where someone takes out a $300,000 mortgage with a fixed interest rate of 4%, which is below the market right now, and they're going to take that term out for 30 years. Using an amortization calculator, we find that in the first year, approximately 67% of that monthly payment goes to interest, or what we reclassify as the bank's profit, with only 33% of the total applied to the principal. For a $1,500 monthly mortgage payment, this means that over $1,000, $1,005 goes to interest, leaving only $495 to reduce the actual loan balance. Fourth thing you need to be aware of with mortgages is the impact on financial planning. The heavy interest burden significantly affects homeowners' financial planning. With such a large portion of their monthly income going towards interest, individuals have less money available for other essential expenses, let alone saving, investing, trying to set themselves up for the future. It becomes challenging to do things like build an emergency fund, save for retirement, or achieve other financial goals. Fifth thing that you need to be aware of with the mortgage is the actual long-term cost of that mortgage. Over the life of a mortgage, the cumulative interest paid can sometimes surpass the original loan amount that was borrowed. For that hypothetical $300,000 mortgage at 4%, interest over 30 years, the total interest paid would be approximately $215,000, nearly matching the actual loan or the principal balance taken out. This just goes to highlight the shocking reality that in some cases, homeowners end up paying double the purchase price of their homes due to interest. And remember, on that 4% scenario, current interest rates are much higher. And then the sixth and final thing you need to be aware of as far as the issues with the mortgage is the equity accumulation. The slow reduction of the principal balance in the early years also means that homeowners build equity at a slower pace. Home equity is the difference between the home's value and the outstanding mortgage balance. Limited equity accumulation can hinder financial flexibility, making it difficult to tap into home equity for potential investments or maybe other financial emergencies or needs. Next up is the credit card quagmire. Credit cards offer convenience, but the hidden costs can be really shocking. Credit card interest rates can soar into double digits, leaving many borrowers trapped in what we call the cycle of debt. Minimum payments barely make a dent in the principal balance, causing individuals to allocate a considerable portion of their net income to service this now financial burden. Shockingly, some people end up paying 2 or even 3 times or more the original purchase price due to the compounding interest on the cards. So here we're going to break down the credit card issues that you need to be aware of. First thing is skyrocketing interest rates. Credit card companies often charge exorbitant interest rates, especially for those with less than stellar credit scores. These rates can easily, reach double digits, making it challenging for cardholders to manage their balances effectively. High interest rates can mean that a significant portion of each monthly payment goes towards interest rather than reducing the actual principal, leading more into the perpetual cycle of debt. Second thing you need to be aware about credit cards is the minimum payment trap. Credit card companies typically require cardholders to make only a minimum payment each month, usually a small percentage of the total balance. While this may seem convenient, it keeps borrowers in that never-ending debt loop. The minimum payment barely covers the interest charges, meaning that principal balance remains largely untouched going forward. As a result, individuals continue to carry high balances, and those interest charges keep piling up month after month after month. The third issue with credit cards you need to be aware of is the snowball effect. The compounding nature of credit card interest can be truly shocking. As interest accumulates on outstanding balances, it's added to the total owed. This means that following month's interest charges are based not only on the original balance, but also on the previously accrued interest. Over time, this snowball effect can lead to a ballooning debt that becomes increasingly more difficult to manage, leaving many borrowers with a mountain of financial stress. The fourth thing that you need to be aware of about credit cards is the true cost of that credit card debt. To illustrate the shocking reality of revolving credit card debt, consider a hypothetical scenario where someone has a credit card balance of $5,000 with an interest rate of 18%. If they only make the minimum payment, typically around 2 or 3% of the balance, it could take decades for them to pay off the debt, and they could end up paying over $10,000 or more just in interest alone. In essence, these individuals would pay 2 or 3 times the original purchase price due to compounding interest. And finally, the fifth thing that you need to be aware about credit cards is the impact on the actual net income, what we're actually talking about. The burden of revolving credit card debt can be overwhelming, as a significant portion of someone's net income is starting to be consumed by the interest payments. This leaves, once again, little room for saving, investing, or doing anything that we need to do or want to do. It also hampers the ability to build a strong financial foundation and can lead to stress and anxiety as that debt continues to mount. Next up is the line of credit leech. Line of credit may appear as a flexible financial tool, and it definitely can be, but they come with their own perilous consequences. The temptation to dip into the line of credit can lead to ever-increasing debt, while the interest charges take a significant bite out of people's net income. What initially seemed like a safety net can morph into a tangled web of financial strain. And so here's the breakdown of what you need to be aware of in the terms of the lines of credit. First of all is the temptation of easy money. Lines of credit provide individuals with pre-approved credit limits that they can access whenever they need it. This accessibility can lead to the temptation of using that credit line for what we call non-essential purchases or expenses beyond someone's means. Unlike traditional loans with fixed repayment schedules, lines of credit offer flexibility, which can lure people into continuously borrowing without a real clear plan for repayment. And the second thing about lines of credit that you need to be aware of is the illusion of safety. Lines of credit may initially seem like a safety net for financial emergencies or unexpected expenses. However, misusing this financial tool can quickly turn into a tangled web of additional debt. Without a disciplined approach to borrowing and repaying, what started as a flexible resource can morph once again into more and more and more of a financial burden. Third thing about lines of credits that you need to be aware of is the variable interest rates. Lines of credit often come with variable interest rates, which can fluctuate based on market conditions. If interest rates rise like they are now, borrowers may find themselves paying more and more in interest charges, which further erodes their net income, which compounds the problem. This unpredictability can create financial stress and uncertainty, making it challenging to budget effectively and forecast as well. The fourth thing that you need to be aware of about lines of credit is just the accumulation of debt. The flexibility of lines of credit can become what we call a double-edged sword. Many borrowers find themselves accumulating debt over time, making minimum payments or only slightly more than the interest charges. This approach barely reduces the outstanding balance, keeping them trapped in a cycle of debt that seems very difficult to escape. The fifth thing you need to be aware about and the issues with lines of credit is, once again, that snowball effect. Similar to the credit card debt, lines of credit can also suffer from what we call the snowball effect of compounding interest. The more borrowers draw from that line of credit and only pay the minimum or interest-only payments, the larger that balance becomes and the more interest accrues. Over time, this escalating debt can become overwhelming, leaving individuals with heavier financial burdens to manage, and once again, that causes additional financial stress. And finally, number 6 on the issues that you need to be aware of with dealing with lines of credit is the impact on net income. Remember, going back to this because this is the topic of this video. As lines of credit accumulate, borrowers must allocate a considerable portion of their net income to service the debt. The interest charges take a significant bite out of their monthly earnings, leaving less money available for essential expenses, savings, investments, or anything else that comes up that's needed or wanted. This strain on net income can hinder financial growth and leave individuals with limited room to maneuver in good times and even less in times of emergencies. The student loan squeeze. Aspiring for higher education is a commendable goal, but the dark reality is that student loans are eating away at the net income of the graduates. Burdened by hefty loan repayments, many individuals struggle to find financial stability, and that affects their ability to invest in their future or make significant life decisions such as starting a family or buying a home. So when it comes to the student loan squeeze, here's the issues that you need to be aware of with the student loan. Number 1 is the true cost of the student loan. When students take out loans to finance their education, they often underestimate the true cost of borrowing that money. Beyond the initial amount borrowed, interest accrues like any other loan over time. Depending on the loan type and the repayment plan, this interest can significantly increase the total amount paid back. As a result, graduates end up repaying much more than the original principal, stretching their financial resources even further. Second thing you need to be aware of as far as the issues with student loans is the financial burden of that repayment. Upon graduation, many individuals are burdened with substantial loan debt. Monthly repayments become a significant financial obligation, often comprising a substantial portion of their net income. Graduates find themselves allocating a significant chunk of their earnings towards that loan repayment, leaving little room for other essential expenses or long-term financial planning. Number 3 is the impact on money management. High student loan payments can disrupt an individual's ability to manage their money effectively. Graduates often might find themselves struggling to save for emergencies, invest for the future, or even start to contribute to retirement accounts. Additionally, they may be forced to delay major life decisions like we talked about, such as buying a home, starting a family, and that's due to the strain of the student loan debt on their financial stability and financial future. And then the fourth thing to be aware of with student loans is delayed financial independence. All of this is leading us to a delayed financial independence. The burden of student loans can hinder young adults from achieving financial independence. Graduates may be compelled to move back in with their parents or rely on family support during the high cost of loan repayment, and coupled with a challenging job market or macroeconomic environment. This delay in financial independence can have long-term consequences on their ability to build wealth and achieve the American dream and financial security. And then number 5, finally, the long-term impact. This is the 5th issue with student loans that you need to be aware of. Student loan debt can have a long-term financial impact on anyone's life. It can delay saving for retirement, limit investments, or prevent them from building significant wealth. The inability to accumulate wealth can affect future generations as well, as individuals may struggle to provide financial support for their children's education or other family needs. And then the car loan crunch. Owning a car may seem like a necessity for many, but the actual cost can be staggering. Car loans often spread over several years, and they come with high interest rates, leading to a considerable portion, once again, of someone's net income flowing directly into the bank's coffers. Many individuals find themselves what we call upside down in their car loans, where the value of the vehicle is less than what they owe, and that creates additional financial strain and limits choices. So here's a breakdown of what we need to be aware of as far as the issues with car loans. First of all is the true cost of the car loan. Remember, everything has a true cost. The true cost of car loans goes beyond the sticker price of the vehicle. Many individuals finance their cars with loans that extend over several years, resulting in substantial interest payments. These high interest rates, especially for those, once again, with less than perfect credit, can significantly increase the total cost of the vehicle over the life of the loan. And then the second thing we need to be aware of as far as issues with car loans is the financial burden of high interest rate car loans. Car loans with high interest rates can place a significant financial burden on the borrower. With each monthly payment, a considerable portion goes towards interest, leaving little room to make dent on the actual principal balance. This can result in a prolonged repayment period and overall higher expenses for that vehicle. Then number 3 issue you need to be aware of that we mentioned in the start of this section is the upside down car loan. Upside down car loans are prevalent issues in the automotive lending market. The situation occurs when the value of the vehicle depreciates faster than the borrower can actually pay off the loan. As a result, individuals owe more than the car is actually worth. This predicament creates an additional financial strain, making it challenging to, sell or trade in the vehicle without incurring more debt and exasperating that debt cycle. And the 4th thing you need to be aware of about car loans is the monthly payment trap. Some car dealerships may offer low monthly payments to entice customers into purchasing a vehicle. However, these attractive monthly payments often come with extended loan terms and high interest rates. As a result, borrowers may find themselves paying off the car loans for many years, long after the vehicle's value has depreciated significantly. And then once again, the 5th issue is the impact on net income, which is the overall topic for today. High car loan payments can substantially impact an individual's net income. A considerable portion of their monthly earnings is directed towards servicing the car loan with the other debts, leaving them with less and less disposable income for other essential expenses, savings, and investments. So the shocking truth is that debt has become an intrinsic part of modern life, with banks acting as the gatekeepers of financial freedom. Millions of hardworking individuals find themselves trapped in a perpetual cycle of debt, with a substantial portion of their net income going directly to the bank. It's high time to address the systematic issues surrounding debt and advocate for education and plans of action and execution of those plans of actions that empower people to achieve true financial freedom. By really understanding about the burden as well as the real and true cost of debt, and then creating a financial plan that actually benefits us versus benefiting the banks, individuals can thrive without sacrificing their hard-earned income to the banks. Millionaire Mindset Life, stretch your thinking, create your vision, and achieve.